I think the screen has gone. No?
It's visible now.
Screen is visible now?
Yeah, it's visible.
Okay. So today we are starting a new topic, that is CAPM. The expansion is Capital Asset Pricing Model. The context is like this. Suppose an investor wants to invest in some stock or any asset which has some risk, let us say market risk, and there is a price prevailing that a stock with face value of 100 rupees is being sold in the market at, let us say, 500 rupees. Before he invests, he has to pause, think over at what price he has to bid for that. Should it be 500 because that was the previous price? If he wants to bid a little more, how much it should be? Should it be 510, 20, or whatever it is? So what should be the correct price of the capital asset? That is the question which every investor may have. So is there any objective norm or a basis for fixing the price of a capital asset? That is the background. Okay. So market means always it is associated with a risk. Since there are n number of assets in the market, one has to look at the market as a whole. So what is the meaning of the market? The combined effect of all the assets. You have to take a holistic view. So then the question is how to combine these dissimilar assets. Okay. So it is in this context we have the index, market index, like BSC Sensex, right? Some of the NSE indices. So these things represent the market. Okay. The risk associated with a particular asset is different from the risk associated with the market, that is the portfolio of all the assets. But then these two independent? No, these two are related. So what is the connection between the return of a particular asset with the return on the market portfolio? So it is in this context the risk of an asset enters into picture. This is known as the beta of an asset, as we will see. And how the CAPM formula, how it is useful in in determining the price of an asset. That is, toward the end, we see that how CAPM acts as a pricing formula. So before this, let us briefly touch upon some basics. Okay. So here I'm going a bit fast because there is very limited time in front of us. And if we go into elaborations, then we won't be able to reach up to CAPM. But wherever you have some doubts or clarifications, I'm giving the reference. So this discussion is from a book. All of you, please note down. The title of the book is Investment Science. Author is David Leonberger. It's a very good book. Okay. So in this, there is a chapter on the portfolio analysis, followed by another chapter on CAPM. So the advantage of this book is that it is very smooth, the presentations are crisp and a bit mathematically oriented, but very simple, elementary type of mathematics. Personally, I like the presentation in this book. That is why I have chosen to treat this topic from that book. And all of you try to get hold of this book, a soft copy or a hard copy. And Gokhale Library must be having this. Now that all of you are online, if you don't have access, I will search. If I have e-copy, I will share it with you. Is that fine? Hello?
Yes, sir.
Yeah, okay. So now our starting point is that we assume that there is an investor, okay? He has at his disposal a quantity of money, that is an amount of money. Let us consider this as X naught. Naught means initial amount, it just meaning that. That is the money available for investment, okay? Suppose he invests this money across n assets, okay? On each asset, he will be investing X0I. I refers to the ith asset. Okay. Suppose if we add all these, if we add all these, I equal to 1 to n. Okay. So that will exhaust the total amount, that is X0. Okay. Now this X0I, that is the amount to be invested on ith asset. Okay. It should be non-negative. It should be non-negative. That is very obvious. Okay. Now let X0I be written as WI That is, what is the proportion of amount that is being invested in ith asset, where WI represents the proportion or the weightage. So obviously, if it is in percentage terms, all add up to unity. If it is simply the proportions like, 1/10 or 1/4, 1/5, 1/6, whatever, all these things would add up to naturally 1. Okay. Now let capital R, let us say RI, is the total return of asset I, Okay. Now Ri X0I, okay. This may be written as Ri. In the place of X0I, right, you write this expression, that is Wi X naught, right? Now for the entire, across all the assets, you just put a summation sign, I equal to 1 to n, okay. So, and if you divide this by the total amount, that is summation Ri X0I upon X naught, okay. So this gives you the total return on the portfolio, okay. So this in turn may
So
be written.
could you please explain what exactly R is and why are we multiplying?
See, R is the rate. Ri, capital Ri, is the
Yes, sir.
rate, is the rate that you get by investing the amount x0i.
Okay,
Okay.
so could you just scroll up for just 1 second for the entire thing?
Sir, so
Yes.
Thank you,
here
sir.
here the total return then is sigma RIWI.
Yeah. This is the total return. That is the total amount. And if you divide by the amount, you get the total rate, that is R. Okay. So
So
this
R will be equal to sigma RIWI, right?
sigma Ri x0i. Yeah, now you can put sigma here also.
Yes, sir.
Sigma here also, then that goes. Okay. So now, as we written earlier, summation Wi should be equal to 1. Okay. So let small r is the return on the portfolio, which is nothing but summation of the return on all the assets I equal to 1 to n. Okay. So therefore here small r, now this is just to develop the background. Capital R equals summation Wi, and small r equals again summation Wi small ri. Okay. So here the total return and the rate of return of a portfolio of assets, okay, they are respectively equal to the weighted sum of the corresponding individual assets. Okay. So this we call the portfolio. Okay. So it is possible to calculate the mean and variance
So,
of a portfolio. Yeah.
so what's the difference between capital R and small r here? Is
Hmm?
small r the rate and the capital R the amount?
See, if you divide this by, okay, if you divide R by x0, that is total amount invested, you get the small r. This is the total return on the portfolio. R is the sum total of the rate of return that you get on each and every asset, 1 to n, right?
Okay, sir.
So how mean and variance of a portfolio, I think these details may not be required because they take time. But here, a portfolio can be diversified away. Okay. A portfolio can be diversified away. As you increase the number of assets, okay, that is, as n increases, the variance of the portfolio declines. So, which means by diversifying the portfolio, you are essentially minimizing the risk. Okay. Actually, I'm skipping so many things because we'll have to reach up to the CAPM, and for that, the background, I'm just giving the conceptual background. So, the most important thing in our present context is the mean standard deviation diagram. Mean standard deviation diagram. What is the meaning of this? Suppose mean is R bar. Okay. Let R bar be the mean of the portfolio. Okay. And sigma, let sigma is the standard deviation of the portfolio. Okay. Now any given asset can be represented in this two-dimensional diagram. This is known as mean variance mean standard deviation diagram. Suppose you take a particular point. So this point describes what will be the return, and associated with that, what would be the risk as measured in terms of the standard deviation. So like that, you take n number of assets. Each asset can be identified in terms of the return and the risk. So that is how the mean standard deviation diagram is very useful in characterizing various assets. Okay. Now,
So,
yeah.
so here the more standard deviation means more risky assets, right?
Yes, yes. Higher the standard deviation, higher would be the risk, and naturally lower would be the return on that. Okay. So that is obvious. But different assets may have different characteristics. Okay. Some assets have low risk but high return, and some both return would be high and risk also would be high. But in any case, conceptually, any asset can be described or can be plotted in this mean variance diagram. Okay. So now the let us discuss further this. Okay. The suppose now covariances. If there are two assets, for instance, if there are two assets, okay, they could be correlated. But the limitation of the mean standard deviation diagram is that they are not shown. Okay, they are not shown here. Now, the whole family of portfolio, okay, we can now represent the entire family or the family of portfolios by introducing a variable, let us say alpha. I'll explain how that is. Okay, by introducing a variable alpha. Okay, and this alpha defines the weights like W1 equal to 1 minus alpha and W2 equal to alpha. Okay, so these are the two assets, and asset 1 is associated with W1, asset 2 is associated with W2. Now choose alpha such that this is basically the formula for convex set. Alpha in the range 0 to 1. 0 to 1. Okay. If alpha is outside the range, outside this range, then one or the other asset has a negative weight. A negative weight indicates short selling. A simple diagram will clarify this idea. Okay. Let us take the case R bar. Okay. So let us pick 2 points, 1, 2. These points are assets, right? So these assets, they span a portfolio. Depending on the alpha that we choose, for example, for a particular value of this, it could be here. It's a real-time continuous curve. So these two assets would generate a portfolio, and the portfolio would be of this shape, which is convex to the origin. Of course, under certain conditions, it could as well be like this. They're always to the left of this, right? So when two assets are combined, for example, asset 1 and asset 2, when these two are combined, in various combinations, right? So the resulting portfolio is not one single portfolio. You have infinite number of portfolios depending on the real-time values that alpha chooses from this range, right? So the combinations are quite many. The resulting portfolio sweeps out a curve, that is this particular curve. It sweeps out a curve like this. Okay. This curve is between the points representing the original assets, that is between this point and this point. Okay. And the exact shape of this curve depends on the covariance between these two assets. The covariance between these two assets. Okay. So now the concept of a feasible set. Feasible set. Okay. So the set of points that corresponds to portfolios is called a feasible set. Okay. Let us take two assets, A and B, right? So using these two assets, you create a portfolio which says sweeps out a curve, a portfolio curve. Okay. So all the points are feasible points on this. Okay. So the set of points that corresponds to each portfolio, each point on this curve is a portfolio. So the set of all those points is called a feasible set or a feasible region. So the feasible set satisfies two important properties. So the first property, let us take a third asset. Okay. The first property is that when there are at least three assets, I think the first property I can explain by considering a third asset. This is asset 1, asset 2, and asset 3. Asset 3, okay. So 1 and 2, they sweep out a portfolio. Then 1 and 3, they also sweep out a portfolio. So that is each value of alpha will give rise to a portfolio. Okay. Now 2 and 3, because these two are assets, they also sweep out another portfolio. Okay. Now let us consider a point here, which is an asset, which is also a portfolio, right? So between 1 and 4, also it sweeps out a portfolio. Okay. Now when there are, let us say, three assets, each asset having different mean standard deviation characteristics. Okay. So the feasible set will be a solid two-dimensional region. Solid two-dimensional region. Okay. Now that is the combinations of assets 2 and 3 sweeps out a curve between them, between those 2 points. Similarly, combinations of one of the three assets, like for example, the fourth asset, together with one, will sweep out another curve. Okay. So the family of all these curves, the family of all the possible curves would form a solid region as marked here. Okay. Now, as I told, the property is the feasible region is convex to the left. Normally, we say convex means like this. Here, depending on the shape, okay. Suppose if you shift the origin somewhere, this is convex. The same thing if you concave, it will be like this. It will be like this. See, the property is that the feasible region, here this is a solid region, that should be convex to the left. Actually, what it means, that is more important for us. And what is the logic behind that? Take the K as usual, sigma r square, right? So the suppose you have points 1, 2, 3, 4, 5, let us say these assets. So with the help of all these assets again, it is possible to sweep out another portfolio, right? So the discussion is that it is first convex to the origin, then it is to the left of all these individual portfolios. What is the logic? Suppose now R is fixed, that is the rate of return is fixed. Suppose at this point, right? So what is the corresponding risk associated with that is this point. Suppose you choose a point here, okay? So the return is the same, but risk is more, risk is here. So therefore any rational investor would not prefer this. It will prefer a point on this, okay? So that is from, if someone is a risk averter, he will always do that, right? On the contrary, suppose you fix a point, let us say here. So this is the risk associated with this. And this is the return. This is the risk. This distance is the risk, and this is the return associated with that. Suppose you choose a point here. You choose a point here, right? So what will happen? Here you are getting a higher return, but the same level of risk. But then would you prefer this point? Because here risk is more. You have a portfolio where the risk is less. So therefore, you switch over to this point. So using this logic, always you tend to be on the left frontier of the portfolio curve. Okay. So now the notion of minimum variance set. One minute. Class తీసుకుంటున్నాను చెప్పు. Now the notion of the minimum variance set. Actually, in this mean variance diagram, since both are varying, we decide one, that is, we pre-assign a value to, say, return. Then what would be the minimum level of risk? Okay? Because when we keep varying both, it becomes indeterminate. So therefore, for a given rate of return, what should be the minimum level of risk? That should be the question. So the left boundary of a feasible set is called the minimum variance set. So this boundary gives all the points on this would give you the minimum variance. But out of all these minimum variance set, okay, we now have to locate a point with smallest variance. And the smallest variance would be somewhere on the vertex of this. If as you move up, risk increases. As you move down, even then risk increases. But at this point of vertex, the sigma value would be the least. Okay, so for any value of the mean rate of return, that is R bar, which is given. Okay, so the feasible point, its smallest variance, is on the corresponding left boundary, and it is on the vertex of that. Okay, so the minimum variance set, that is this particular curve or the region. Okay, this is typically the shape of a bullet. This is typically the shape of a bullet. Now, in this bullet, you have above this, and let us say one curve above this and another curve below this. Okay, and this is the minimum variance point, right? So our relevant is this part. Okay, so now the focus would be more on this. But what is the reason? So this is known as the efficient frontier. Efficient frontier. Efficient frontier of the feasible region. So the efficient frontier gives the best mean variance combination. This gives the best mean variance combination. Of all the combinations, most efficient is this. That's how it is called the best. Like in econometrics, the minimum variance unbiased estimator is known as the blue estimator. In your econometrics, you may have learned that. Okay. So now we formulate this in terms of a model or a theorem known as the Markowitz model. The theorem goes like this. Let there be n assets. There are n assets. Their mean rates of return are for each of the asset r bar 1, r bar 2, etc. r bar n. Okay, and their covariances are sigma ij. Okay, ij running from 1 to n. Okay, now a portfolio is defined by a set of these n weights. We construct a portfolio using n weights, WIA, such that their sum is unity. Of course, negative weights are allowed wherever there is some short selling. Okay. Now, to find the minimum variance portfolio, in this, the minimum variance portfolio, okay, how do we work it out? Okay. So this is, it's a optimization problem. Minimize some double summation I j wi wj. Okay, variance, this is quadratic. And of course here half is, it doesn't matter because this is a constant, subject to summation wi r bar I equal to summation wi equal to 1. So this is the the optimization problem. Okay, so to work out the minimum variance portfolio, actually the portfolio means essentially you will have to determine the weights. How do you determine the weights? Through this optimization process. Minimize the objective function subject to these two constraints. Okay. So to solve this problem, there are two approaches. One, the numerical methods, and two, the analytical methods. Okay. So we are not going into those details because the solutions you will have to formulate Lagrangian, then work out the first order conditions, which are linear functions, etc. Okay. So here, sometimes through analytical methods, you may not be able to work out a feasible solution. Sometimes it is very cumbersome.
So could you please explain the sigma sigma wi wj, like how are we, how does one read that?
Suppose I equal to j. Suppose I equal to j. Then what happens is, let us say it is wi,
Right.
wi square sigma square I. Actually, what is this? This is nothing but the variance. Okay, variance. Whether you minimize variance or standard deviation is one and the same. So this has to be minimized. Are you following? Okay. Since we have n portfolio, n assets, right? We also take the covariances, but the sum total has to be minimized. That is squares as well as the cross products. So the objective function here is one of minimization. But then there are constraints. What is that constraint? The total return should be the sum total of the individual returns. That is one. And all the weights should add up to unity. Subject to these two constraints, you minimize this. In the process of minimizing, you will have these wi hats. So once you know wi hat, that means you will know the portfolio. After all, what is portfolio? What proportion is to be invested from the total amount on a particular asset? That gives you the portfolio. Okay. Now for this, various.
So may I ask, how did he arrive on this? I'm a little confused, like how we
Okay.
arrived.
Which one?
So again, the same one, the minimization function.
See, actually, what are you trying to minimize? Sigma square I.
We tend to minimize the portfolio variance.
Total variance.
Yes, sir.
So total variance consists of individual variances. That is sigma square I. Sigma square I. You add up all those things with some weights and you will get the portfolio variance, right? So what is to be minimized is that variance. The reason is you are trying to minimize the risk. Okay. And that idea is translated into this function. So tell me what is confusion here?
Also, sir, there's is that a 1/2 in the starting, or what is that?
See, this is some constant. Suppose now you are minimizing, let us say, sigma square. Even
Right.
if you multiply by some
Then
constant,
it should not have an impact on it.
yes, that is the idea.
Yes.
But then why 1/2? Because when you differentiate, somewhere in the numerator 2 will come.
2 will come.
Double summations. So that cancels off and you get a nice expression. Anyway,
Okay.
you are equating to 0.
All
That
right.
is the reason for multiplying by some constant, which is 1/2 here. Okay.
All right.
Constraints are clear?
Yes, sir. Constraints are not much of an issue.
Okay, okay.
Sir, if I may just ask,
Hmm.
did we get this minimization function from the formula that we use for group standard deviation?
Portfolio standard deviation.
All right, sir.
Yeah, yeah. Is exactly that. In fact, I have not done that because it will consume time.
Yes, sir. Yes, sir.
Yeah, working out the portfolio. Then as you diversify the portfolio, how it vanishes, etc. All those things I have skipped. But it is precisely that. Okay. Now, the solution for this, right? Actually, what is the meaning of solution? You will have to work out Wi hat. But we want a kind of unique solution, right? Sometimes there could be multiple solutions. Okay. But each solution gives you again an asset. For example, you have a solution like W1 is equal to W11, W21. The superscript 1 tells you that it is solution 1, Wn1. This is a vector of solutions. There is another solution, W2, 2, W22, so on, Wn2. So let us pick up two solutions, okay? And along with these two solutions, when you run the minimization program, okay, you will have two more, that is lambda hat and mu hat. These are the Lagrange multipliers. Those who are technically inclined, they may quickly grasp this. These two are Lagrange multipliers. Anyway, ignore this part about the Lagrange multiplier thing. Associated with is also lambda hat associated with the second solution, mu hat associated with the second solution, right? So these, I think, for the time being, you just ignore that. So let there be two solutions. So this solution gives you one portfolio. If you multiply with the corresponding assets, is this not a portfolio? Hello? Is this not a portfolio? Yes. So corresponding to each of these portfolio, there would be rates of return, let us say R bar 1 and R bar 2. Okay. So now you can, this first solution gives you one portfolio, and portfolio is also an asset. And the second solution is also an asset. Since these two portfolios you can combine and you will have again a portfolio. For example, you can have alpha W1 plus 1 minus alpha W2. You can have a portfolio, okay, subject to R plus 1 minus alpha R bar 2. These are the corresponding returns. Since W1, W2 are solutions to the n plus 2 equations. Actually, in the optimization problem, we have n number of equations here. Okay, n number of equations here. When you work out the first order condition, there will be one when you differentiate this. Okay, this is 1, and another, this will be 1. So in all, you will have n plus 2 equations. Okay, so these two, that means we have n plus 2 linear combinations. That is, this solution represents a point in the minimum variance set. So here, the idea is that it is possible to create if you have n assets, say 2 portfolios, and out of these 2 portfolios, you can again create another portfolio, and that portfolio could be of this nature. This is that portfolio. That is, you consider 2 efficient portfolios, and out of that you construct another portfolio, right? So when you have, let us say, some money, and if you want to invest, you don't have to scan through a large number of portfolios. Okay, so it is sufficient if you consider 2 funds. Okay, and combine these 2 funds in some way or other. That is, this is one fund, a fund given by this portfolio, another fund given by this portfolio. So it is sufficient for any investor to look at only these 2 funds. By combining them, okay, you will have a portfolio which would tend to be efficient. So this is known as the 2 fund theorem. That is, 2 efficient funds can be established so that any efficient portfolio can be duplicated out of these 2 funds in terms of their mean and variance. Okay, that is by combining these 2. That
Please
is,
repeat that. 2 efficient funds.
see, W1 gives you one efficient portfolio. W2 gives you another efficient portfolio. These are efficient because these are feasible portfolios, and you worked them out of the minimization process, right? So now any investor may look at only these 2 funds. It doesn't have to work out other portfolios. By combining these two funds, you will have another, you can seek another efficient portfolio. So that means he has to look at only these 2 funds. That is the idea. Okay. Now,
So is this similar to saying that we only need 2 funds to create the efficient frontier? Amongst
yeah,
all?
not again, that is not unique. Suppose now you go to the market, okay? So from the market, you consider, let us say, 2 efficient funds. Of course, you may ask me, who gives you these efficient funds, right? So already, funds are worked out that if you combine these in this fashion, this is one fund. If you again combine this fashion, is another fund. If you want to choose a portfolio, better you combine these 2 in some way. In whichever way you combine, that will be an efficient portfolio for your purposes. You don't need to again scan through various combinations of the n assets. That is the idea behind this. Okay. Now coming to our purpose, right? For CAPM, there is a market. Let us say stock market, right? So for the stock market, or bar, right? So you introduce what is known as a risk-free asset. A risk-free asset. The meaning of that, all of you know that. It's an asset whose risk is 0. That is why this is falling on the vertical axis, because value of sigma is 0. Okay. Now, you also have the notion called the market portfolio. So let this market portfolio be represented by M. Okay. So the line joining these 2 like this is known as capital market line. Here, the idea is that in the market, suppose there is an excess demand, then what happens? More people place orders for that stock. Okay. As a result, okay, the prices of some stocks go up and some stocks may also come down. But the mean variance portfolio is adjusted accordingly when certain things are going up and when certain things are coming down. So the mean variance portfolio is adjusted. And this adjustment, here this is an assumption. Everybody adopts this portfolio, that is this particular adjustment. Then the prices drive the market efficiently. The prices drive the market efficiently. So that means that the market portfolio is the efficient portfolio. Okay. So now, with reference to a risk-free asset, that means you have now two funds. One is the market fund, that is the market portfolio. Let us say the BSC, Sensex, or any NSE index. So that is the fund which represents the market, and that is the market fund. In addition, you always compare that with a risk-free asset, like the treasury bill rate, because on that there is absolutely no risk, right? So consider these two. If you work out a portfolio, so that will be a linear line like the one that is shown here, and that is called the market line. Okay. So this market line, with a little bit of your two-dimensional geometry, you can write the equation for, please remember in your maybe plus 2, etc., you have y equal to mx plus c. Okay. Here y is nothing but your r. Like that. R bar equals RF. The C is RF plus R bar M minus RF upon sigma M. This is sigma. Okay. So the equation for R bar is given like this. This is analogous to this y equal to mx plus c. So here M is the slope. If you differentiate R bar with respect to sigma, you get this is 0 because this is fixed. R bar M minus R of F sigma M. Okay. So this is known as the price of risk. Why it is called the price of risk? You look at this is basically a linear relationship connecting return and risk. Okay. So the coefficient associated with that is referred to as the price of risk, right? So remember this. From this, we now formulate the CAPM. The CAPM equation is the expected excess risk of an asset. See, this R bar means that is the expected. This R bar means it's not average. This is understood as the expected risk over and above the risk free. That is, this is fixed. And the difference between the two is the excess expected return, this term, equals beta I times R bar M minus R of F. Okay. So this is known as where beta I is defined as the covariance between the ith asset and the market portfolio standardized by sigma square m. Okay, so let us focus on what is this about. The CAPM formula says that the excess expected return of an asset is directly proportional to the expected excess market return. So that means what you expect from an individual asset which is risky is directly related to the market return, and the risk is given by beta I. So that means how closely the asset representing the market and the individual asset, how closely they are related. So that means their covariance, and that covariance is standardized by the variance of the market portfolio. And this is referred to as, beta is referred to as the risk of the asset. Risk of the asset I. Okay. So all of you should try to remember this formula. You have any clarifications on this formula with regard to symbols? What is R bar I? Anybody? Hello?
So expected risk.
Expected return. R
Okay.
bar is expected return of ith asset.
Over the risk free.
Yeah. RF is the return on the risk-free asset, which is fixed. This is fixed. Okay. So the deviation from this, if it is positive, it means you are expecting more return. Okay. When you are expecting more return, obviously there is also a market risk. So this should have, this excess return should be related to the market excess return. What is that market excess return? This is market return. That is return on the market portfolio over and above the risk-free return. So the difference is excess. So this excess for individual asset is related to the excess of the market. These two are related. How these two are connected? By means of the risk of the asset. Risk of the asset, which is beta I. And that is given by the standardized covariance between the asset and the market portfolio. Okay. So this beta I therefore is referred to as the risk of the portfolio, right? Now, there are alternative interpretations to the beta. Suppose now the RF, with RF as the base, we can interpret this as Ri bar minus R of F is directly proportional to R bar M minus R bar F. Okay. So one way of interpreting is that for a given risk, that is beta I given, right? You can write these two as directly proportional. Directly proportional. Okay. So this interpretation directly follows from this. Like, if x equal to k times y, then you can as well write X is directly proportional to Y for K positive. This is something like very simple. Okay. Now the second interpretation, is this clear? What are you relating in this? Hello, anybody? The excess return on ith asset is directly proportional to the excess market return given the risk, that is given beta I. Second, if beta is a normalized version of the covariance of the asset with respect to portfolio, the meaning of that is just this. If beta I is the normalized version of the covariance. What is covariance here? This is covariance. And what are you doing with the covariance? You are normalizing by dividing it by, what are you dividing by? Dividing by the variance of the market portfolio, right? So then the second interpretation is that R bar I minus R of F is directly proportional to beta I, okay, given R bar M minus RF. This is given, read this as given, okay. It is very simple. First, you treat this as given, establish the proportionality. In the second, you treat this as given and establish proportionality here. But these two versions have two different implications. Okay. So in the first case, you are treating the risk as given. And in the second, you are treating the excess return, market excess return as given. Okay. Any questions on this? Hello?
No, sir, I think it's fine.
Okay, fine. So now a few questions. Can beta be negative? What
Yes,
should
sir.
be the, huh?
Yes, sir. I feel beta can be negative.
Okay. Can beta I be 0?
Yes, sir. I think so too.
Okay. What happens when beta I is 0?
So
Go back.
basically, the fund is or the asset is following the market very well.
Hmm? No, no. Recollect the formula.
So the excess return,
Yeah.
the
So
excess
beta
return.
will be 1 when the asset is following the market exactly, right?
Hmm. This is that. Hmm? Suppose beta equal to 0, then the right hand side is 0. Right hand side is 0, then R bar I equals RF. Okay. So what does this mean? This means your expected return is the same as your risk-free return. Risk-free return. Even if your sigma is large. Even if your sigma is large. What is sigma? What is sigma? Sigma is the risk actually. Risk of the, it represents the risk of the asset. Okay. One moment, please. Hello? Hello? Sorry. Anyway, the idea here is that the return that we expect is the same as the return on a risk-free Hello? Hello? Hello?
Oh, yes, sir.
Hello,
You
sir.
are audible.
So, what happened? You are there?
Yes, sir, we are there. We are waiting for you. I think you would have lost connection in the middle.
Yeah, and now is it okay?
Yes, sir, it's fine, sir.
Is the screen visible?
No, screen is not visible, sir.
Okay, let me again. Hmm. Is it visible now? Hello?
Yes,
Okay,
sir.
okay. So now the CAPM equation may be written as R bar I equals RF plus beta I R bar M minus RF. Okay. All that is done here is that RF, which was on the left hand side, I shifted it to the right hand side. Suppose now you are interested in estimating beta hat. Okay. So how will you do that? So since this is financial econometrics course, right? We can't help introducing the error term because for econometrics, this is very crucial. Suppose you are given data. Suppose you are given data on RI, data on RF, data on RM. Okay. Suppose given these three, how will you estimate beta I? Anybody? Okay. Tell me how will you estimate beta I from this? Ignoring for the time being that this is not there. When you write Ri bar minus Rf upon R bar M minus Rf. This gives you beta I. Am I right? Hello?
Yes, sir.
Hello? Yeah. But what is the problem here? The problem is you are not estimating beta I from the data that is given. All that you are doing is in a very deterministic fashion, you are calculating this by dividing the left hand side by this part of the right hand side. But beta I, which is the risk of the asset, right? You have to calculate first sigma IM, that is the covariance between R bar I and sigma RM, sorry, RM. Okay. And you also need to calculate, then take the ratio of these two, you get beta I. But this way of computing is deterministic. This way of doing is deterministic. But now our interest is that beta I should be estimated. For estimation purposes, we will have to introduce the error term. What is the implication of that? The implication is that the excess return, right, has some benchmark return, which is in the form of risk-free return, plus it also has some component of risk of the asset and the risk of the excess return on the market portfolio, right? So this is typically like a regression relationship like y equal to a plus bx plus u. Okay. So now here you have to estimate b. Using your least squares principle, etc., you have to estimate b. So for that purpose, you need to make some assumptions concerning u. What are those assumptions? The mean of u, that is expectation of ui, should be equal to 0. Expectation of ui, that is covariance, you write as covariance between ui and r bar m should be 0. These two are not expected to be correlated. This and this, they should not be correlated. They should have mean 0 and of course constant variance, etc. Okay. So now when it comes to estimating and the beta, you first work out from this relation, from the above relation, that is from this relation, direct you write variance of r bar I equals sigma square I, you write like this, sigma square I, this is beta I square, sigma square m plus variance of u. That is from this relation, directly you can write variance of this will be 0. And here variance of this is beta I square and variance of this is nothing but sigma square m, right? So this has two parts. This has two parts. Actually, what is this? This is variance of the return, expected return. It has two components. One component is this and another component is this. So this component of the risk is known as systematic risk. This is known as systematic risk. And the systematic is associated with the market. It is associated with the market. And this risk is known as non-systematic or another term is idiosyncratic. Idiosyncratic or specific risk. Okay. So this market risk cannot be diversified away. Why? Why it cannot be diversified away? Hello? Hello?
So this is because whatever we do, even though we are trying to beat this, we can only try to estimate this systematic risk. But even despite doing that, we will always have to deal with the non-systematic, or as we call the specific risk.
No, no. My question is, why systematic risk cannot be diversified away?
So because it impacts the entire economy, so it's not specific to one industry.
It is not in our hands.
Yes.
It is in the hands of the market. Very simple. Okay. Whereas the specific risk associated with a particular asset, right? can be diversified away. If you feel the asset is very risky, either you can reduce it, the quantity that you invest in that, or you can sell it away. So that can be diversified away, or it can be minimized. Okay. So now let us revisit the capital market line vis-a-vis. This is the mean variance diagram. Okay. This is your RF. This is your M. Okay. Suppose you have A, B, C funds. Each is a fund, and the funds are represented in the mean variance, mean standard deviation diagram. But these three are funds. Okay. So these assets have non-systematic risk. These assets carry non-systematic risk. Okay. Why? Anybody? Because they are not on the capital market line. Okay, which is considered as an efficient portfolio. Whereas this asset has systematic risk. Whatever market risk is there, this carries only this. Whereas these things, they carry non-systematic risk. Okay. Now there are also other measures which I think I should introduce now. Is it that the CAPM relation always holds good? Okay. That is R bar I equals RF, which is equal to, let me write with some gap, beta I R bar M minus RF. This is your typical, sorry, minus. Just read this as minus. Okay. Now you add a constant J. So this J could be understood as an error. J could be interpreted as an error. Okay. Suppose now you estimate this relation. This is the expected return on ith asset, put a cap, meaning that it is estimated, and similarly put a cap here, estimated. So now this J is referred to as Jensen index. Jensen index. Okay. If Jensen index is non-zero, it falsifies CAPM. Okay. Because according to CAPM, what should be the value of J? Hello?
According to CAPM, J should be 0.
Yes. Right? So if J is greater than 0, then the ABC fund, which we have just marked, has done better. Is it so? This is ABC. After all, what is J? J is the deviation. Okay? J is the deviation because they are not on the capital market line. They carry only non-systemic risk, right? And non-systemic risk can be somehow diversified away. So therefore, if J is greater than 0, or then is the points outside the capital market line, are they doing good? Think over. Next measure is Sharpe measure or Sharpe index. This is defined as R bar hat minus RF. This is equal to S multiplied by sigma, where the value of S is the slope of the line connecting the risk-free point, that is RF, and ABC point. That is, look at here. Okay. So suppose consider all these things as a portfolio. Let us say the point is here. The slope of this is capital S. Capital S. So this is known as the Sharpe measure. Okay. So it is known as the Sharpe index. If the Sharpe index is not unity, then CAPM is falsified. Okay. So for Jensen index, let me write. Earlier I didn't answer this question, thinking that you would. R bar. This is point M and this is R. Okay. So suppose this is ABC fund, which is above this. And this deviation is your J, Jensen index. Okay. And similarly, RF, R bar, let us say somewhere, this is your M. Suppose this is ABC point, right? The slope of this, actually the slope of M should be this, whereas the slope of this ABC fund is this. So this is Sharpe ratio. This is Sharpe ratio.
So could you repeat the definition once?
Here, Sharpe index is defined as this. Okay.
So, sir, is it simply the slope, or is it the ratio of this slope to the SML?
See, equal to RF plus, okay. So this is like your Y equal to
MX plus C.
C. And this M is nothing but your S.
Yes,
X is
sir.
nothing but this. And this is nothing but C.
So,
And
sir, we want our slope to be equal to 1, or we want it to be equal to the slope of the market line.
see, in CAPM, suppose the slopes are equal. What are the slopes? This is the same as this. Then this line will converge with this. Then this ABC point will be on this capital market point, which means CAPM is valid, isn't it? So only when there is a difference in the slopes, okay, difference in the slopes, that means there is the Sharpe index or Sharpe ratio. So you may want to know why it is called a ratio. Is that if you want to show it as a ratio, you divide this by sigma, this left hand side thing here, and you get S. Here the idea is the divergence in slopes. When there is divergence, then this particular portfolio is not on the capital market line, right? So it has different mean standard deviation characteristics. And the gap is measured in terms of the Sharpe ratio, okay? Now the main focus is why CAPM is a pricing formula. Because the whole logic underlying CAPM is that it determines the price of a capital asset. How? Let us see. Let P be the initial price of an asset. Initial price of an asset. Okay. So let Q is price of the asset after some time. After some time. Or after a period of time. Okay. So then R, that is the rate, is Q minus P upon P. Okay. Very simple. But here, is P known? Come on, follow me. Is P known? Yes, it is known because that is the initial
Yes,
price.
so it is known.
Is Q known?
No, sir.
It's not known. So when it is known, it is uncertain. So it is random. Okay. If you expect it to be at some level, that may or may not materialize. Hence, it is random. Okay. So since it is random, you put a bar on that. Let me. Now you write this as Q bar minus P upon P. What is this? This is nothing but your R bar, isn't it? R bar is the expected return. So we had put bars because of that. This equals R of F plus beta into minus R of F. Okay. Now from this, you invert this and work out P, write it in P on the left side. Q equals Q bar upon 1 plus R of plus beta multiplied by, okay. So this is the relationship that we may have, okay. So what does this mean? Or alternatively, you can as well write Q on the left hand side, okay. So if you write Q on the right hand side, what the price of P is going to be after some time is decided by the initial price, the price of the risk-free asset that is available in the market, plus the asset characteristic, that is the risk of the asset, that is beta, and of course the market return. Okay. So the price P of an asset, the price P of an asset with payoff Q, with P of Q is given by this. the initial price P has a payoff Q after some time. Okay. So therefore the initial price equals in terms of the payoff is the formula. Alternatively, if you want to pay the price right now, what should be the price that you have to pay? The initial price that you have to pay, it depends on the expected price, that is Q bar, okay, plus you have to take into account the risk characteristic of the asset, that is beta, and also the market return. So in that sense, CAPM is a pricing formula. Okay. You have any questions on this?
So could you just scroll up 1 second?
There is nothing up. I just.
Okay, so no issues.
No, actually, this is your CAPM relation. Okay. In the place of R bar, you are substituting this. What is this actually? This is initial price is P, and the price after some time of that is Q. So the difference divided by P is nothing but your R bar. So you are writing the return of the expected return in terms of the payoff of P, that is Q bar. So if you want to right away buy that capital asset, how much you should pay, right? That is the question. You should pay that much, which is equal to this much. And what is this much? This contains an element Q bar, which is not known to you. It depends on the chance factors. And how the chance factor works out, it is related to the risk of the asset, and also the market return. So that is the idea that it could be used. Okay. Next, there is a notion called linearity in pricing. There are two prices, P1 and P2, for two assets respectively. P1 equals Q bar 1 upon 1 plus R of F plus beta 1 R bar M minus R of F. Okay. So let there be another P2. Similarly, Q bar 2 upon bracket 1 plus RF is the same, whereas this changes to beta 2. And market is the same. This factor is the same. Let me put a flower bracket. Okay. Suppose now you add these two, P1 plus P2. Suppose you want to know when you add up these two prices, initially how much you have to pay for two different assets. That will be Q bar 1 plus Q bar 2 upon, it will work out 1 plus RF plus beta of 1 plus 2. That is the combined risk. RM minus RF. Okay. So this formula facilitates this. So what is the implication of that? The price of sum of two assets is the sum of their prices. The price of a multiple of an asset is the same multiple of the price. So that means P1 plus P2 add up their two payoffs and also add their respective risks, and formula remains the same. Okay. So that means The CAPM formula admits the linearity in pricing. Okay. So the linearity in price is also sometimes known as the certainty. It can be derived in some other form known as certainty equivalence. Okay. So you want to know more about this? Or you are already
So,
expressed this?
so before we start,
Mm.
I think time is nearly over.
Mm.
So could you just please once more explain why is CAPM called a pricing model? Like I'm not understanding. Like I know we have formulae and all of that,
Mm.
but why exactly are we calling it a pricing model?
Suppose now you go to the market. You want to buy an asset. There is a price prevailing for that asset. Okay. So you may have a doubt whether you should pay that price or not. Okay. You start asking yourself whether the price of the asset is really the correct price or not. Okay. How do you convince yourself? One way is it is there in the market, let me accept it. If you ask for less, nobody will give you. If you want to pay more, that is irrational. Okay. So you are in a kind of situation where what is to be done? So you need a mechanism, a rationalizing mechanism to justify whether the price that is being quoted is correct or not, for you to take a decision whether to buy or not. So for that, you have some idea about how risky the asset that you propose to buy could be. Of course, given market risk, that is, market return is the same for everybody. The risk-free rate, suppose the risk-free rate is very high, then why do you go for buying a risky asset? It is always lower in normal cases. That is also known to you. Over and above the risk-free return, you should get something. But to expect that something, you need to take some risk. And that risk is the risk of the asset. Okay. So taking into consideration the risk-free rate, the risk of the asset, the market return, and the expected payoff. Suppose you arrive at another number. Let us say P prime. P is the initial price, and based on your calculation, it is P prime. Okay. Suppose P is less than P prime. Straight away buy it. Suppose P is greater than P prime. You hold on. Okay. So is this not serving as a pricing formula? Hello?
Yes, sir, getting it, sir.
Yeah, I think it is that.
And so,
So
what's Q bar in that formula? Is it the mean price?
that is the payoff. Payoff in the sense you expect that its price would be at the level of Q, say after some time, right? Say next week, let us say, P would be reaching Q. It may be more or it may be less. It is a subject to expectation. Okay?
So, but it is unknown to us.
Yeah, it is random actually. It is
Okay.
unknown. It is unknown. But you will have a guess. See, for why things are random, why things are unknown. See, if something is unknown, you will always have a guess on that. Okay? That guess may be around the true value. If your guess is correct, you correctly guess is around its realized value after some time. Okay, that is how it is random variable. So that is Q would be P plus some U, and this U is random, which is not known to you. Okay, so that is how we put a bar on this, because it's a random variable. It's a random variable because U is a random variable. Okay, random variable doesn't mean that you have no idea about it. You have some guess. Okay, if let us say after some time this P becomes P prime. Okay, if the divergence between Q bar and P is 0, your guess is correct. Your guess is correct. If it is not equal to 0, right? If Q bar is greater than P prime, you will be happier. But nevertheless, your guess has gone wrong. So you accurately guess when it is equal to 0. Okay, that is how it is a random variable. On what factors does it depend? It depends on your subjective distribution of that gap, that is distribution of U. Okay, that here our focus is more on the fact that you are taking into account the riskiness of the asset that you propose to buy. Okay, you also take into account the benchmark, risk-free rate, and also the market return. These are the three major factors that would go into your calculation. In addition, so that means your guess about what P would be, that is your guess about Q, is standardized by these factors, sum of all these factors. And that is what the present price that you should pay. Okay, if it is more than the prevailing P, you don't buy. You will buy or you don't buy. If the price that you arrive at for that asset, if it is more, then you will not buy. It is cheaper to buy at P rather than the price that you work out using CAPM formula. So in that sense, I think it is called the pricing pricing formula for a capital asset. That is how the CAPM model has come into existence. Okay. So any questions? I think your end semester will have a question on CAPM. Okay. There will also be a question on one or two questions on volatilities. Plus, there is one topic which could not be covered. That is on market microstructure. I request all of you to prepare some material for a short question on market microstructure. Okay. All
So
right.
what is the thing you mentioned after CAPM?
Market microstructure.
So I think you mentioned something in the middle, which we
Question on volatility.
Yeah, that already I covered that. See, volatility we have covered in detail. All this mainly concentrate on the Arch 1.1 model. It has high utility in practical applications, and also some asymmetric Gauch models like GJR, one of those models. Okay. And later on, when you have vacation or when you get time, try to have some hands-on experience by estimating these models using some package like Strata or even eViews or even your ARP software, whatever you are comfortable with. All right.
So should we expect the syllabus you've taught earlier to also come?
Earlier means?
Earlier, sir, you taught about efficient market hypothesis.
Yeah, it will be there. See, and semester means the cumulative of all this. Hmm? That's an important theme, no? How can you ignore that? You have already written a test on that. Just brush up. Hmm? What is the problem with that?
No problem, sir. Not an
Yeah,
issue.
So what
Yeah.
kind of questions we can expect, like numerical based, theory based?
Numerical. Even if there is numerical, that will be very simple. Mainly concept based, clarity of exposition, questions of that type. Hmm?
Okay, sir. Thank you.
Yeah, right. So all the best for your end sem exam and also in your future endeavors. Okay.
Thank you, sir.
Welcome.
Thank you, sir.
Welcome. Welcome.
Thank you, sir.
Thank you, sir.
Welcome. Welcome.
Thank you, sir.
Welcome.